Welcome to The Explainer. Have you ever stared at the financial headlines and just thought, okay, this makes absolutely zero sense? Like, you're seeing absolute chaos in the world, conflicts breaking out, supply chains snapping, yet the stock market is somehow breaking records. It's wild, right? Well, today we're going to look right past that traditional media narrative and uncover the cold, mechanical reality of the modern stock market. We're going to completely deconstruct the illusion of the so-called relief rally. Okay, let's dive into this. It's a bizarre cognitive dissonance, isn't it? I mean, we literally had Middle East conflicts actively dismantling global supply chains, yet somehow the market was hitting all-time highs. Seriously, if war is inherently bad for the economy, and let's be real, it absolutely is, why on earth do stocks actually go up? Well, the answer is definitely going to surprise you. Let's trace back a bit. Starting in late February, right after the airstrikes and the closing of the Strait of Hormuz, the market suffered its worst 5-week losing streak in almost 4 years. Things were looking grim. By March 19th, experts were bracing for a massive, system-breaking oil shock. But then, seemingly out of nowhere on April 7th, a ceasefire gets announced. And what happens? Literally, the very next day, April 8th, the Dow jumps over 1,300 points. Boom! The mainstream media instantly jumps on this, labeling it a massive relief rally, basically claiming the markets were just throwing a giant party for peace. Now, what's really interesting about this data is that it completely shreds that narrative, that whole world peace story. Yeah, totally wrong. Data from Windward AI, they're a maritime intelligence firm that uses satellite radar, showed there was actually a 96% decrease in shipping activity through the Strait of Hormuz compared to pre-war baselines. It was basically a ghost town. They only detected 5 outbound carriers, so there was no actual peace on the water, meaning if the relief wasn't real, what actually caused the market to completely explode?
To really grasp how impossible this rally seemed at the time, you've got to remember the sheer terror gripping Wall Street just weeks prior. Take commodity analyst Rory Johnston. He was out there warning that if we needed to shed 15 million barrels a day of global demand, we'd see Brent crude hit $250 to $300 a barrel. He literally called that scenario depressionary. So the sentiment heading into that ceasefire wasn't just, slightly bearish, it was absolute pure panic. And we can actually see that exact panic mapped out in the hard numbers. Data from Goldman Sachs' prime brokerage desk shows exactly what Wall Street hedge funds were doing right before the rally. In Q1, hedge fund selling was the heaviest we'd seen since April 2020. Gross leverage, which is borrowed money, was sitting at an eye-watering 300%. Plus, short exposure to macro ETFs hit its highest level since the pandemic. Basically, everyone was betting the house on a massive crash right up until the exact second the market ripped higher.
Which brings us to Section 1, the 3 falling dominoes, the mechanical truth behind the rally.
Domino number 1, the classic short squeeze. Remember all those hedge funds we just talked about, heavily betting against the market? Well, when you short a stock, you're borrowing shares to sell them, hoping you can buy them back cheaper later. But if the price goes up instead, you are trapped. You start getting margin calls from your broker, and you're literally forced to buy back those borrowed shares at higher and higher prices. That forced buying pushes the price up even more, which triggers even more margin calls, and suddenly you've ignited this massive mechanical buying frenzy. It's like a powder keg going off.
But here's the thing. The squeeze was really just the spark. Domino number 2 brings in the machines. Enter the CTAs, or commodity trading advisors. These are systematic, rules-based, algorithmic trading firms. They completely ignore the news, they don't care about geopolitics, and they definitely don't care about a ceasefire. They just blindly follow mechanical trends. Going into April, these mindless algorithms were sitting on a massive $30 billion net short position. But the second the S&P crossed specific trigger levels, those models mechanically flipped. And they didn't just go to neutral. Oh no, they flipped straight into longs. And the sheer scale of this flip is just mind-blowing. $86 billion. Goldman originally estimated these CTAs would need to buy maybe $40 billion to exit their shorts. Nope. They ended up buying $86 billion in just 5 trading sessions. To put that in perspective, according to Goldman's records, that is a top 5 buying speed print in the entire history of the market. This wasn't human optimism or a sigh of relief. This was raw, unstoppable algorithmic force.
Which brings us to the third and final domino, the negative gamma regime. According to the data platform Spot Gamma, the options market was in a very specific state, where dealer hedging becomes pro-cyclical. So here's what that actually means in plain English. The dealers who take the other side of your options trades have to stay delta neutral to manage their own risk, right? Well, as prices rose from the short squeeze and that massive CTA buying frenzy, these dealers were mathematically forced to buy the underlying stock just to balance their books. Price goes up, dealers are forced to buy more. It's stacked perfectly, and I mean beautifully, on top of the other two dominoes. A short squeeze, an algorithmic flip, and dealer hedging. And listen, this is definitely not a one-off event. Take a look at these historical examples. December 2018. Jerome Powell says literally one word, patient, and the Dow explodes over 1,000 points in a single session. Fast forward to August 2024. The Bank of Japan hikes rates. The yen carry trade unwinds, the Nikkei drops 12%, and then wildly bounces 10% the very next day. The catalysts are completely different every time, but they trigger the exact same hidden market mechanisms.
All right, let's move to Section 2, the macro zoom out, a 20-year structural shift in finance.
And this brilliantly illustrates a massive, fundamental change. To really understand this, we need to take a step back. Think about the market 20 years ago. It was dominated by humans, right? Portfolio managers, doing deep fundamental analysis, reading through earnings reports, debating valuation models to find the true worth of a company. Contrast that with the market today. It is entirely dominated by algorithms, passive funds, options dealers, and real-time reactive trading. That old-school stock market of purely finding undervalued companies, it's essentially a ghost.
Right now, a giant 63% slice of all U.S. stock funds are held by passive indexers. The remaining 37% is active and other. That means the vast majority of the capital flowing into the market is doing so entirely on autopilot.
Think about the scale of that for a second. That 63% slice represents $13 trillion. $13 trillion of completely blind money. This money doesn't care about geopolitical conflicts in the Middle East. It's not reading earnings reports. It genuinely doesn't even care if Apple or Microsoft had a stellar quarter. It just mechanically buys the index, following the rules without asking a single question.
And because most of these passive funds are market cap weighted, they just automatically feed the biggest companies by default. It's a rich get richer setup. The bigger a company gets, the more of it the blind money buys. That is exactly how just 7 companies, you know them, the Magnificent Seven, now make up a staggering 33% of the entire S&P 500 index. A huge chunk of the stock market isn't even experiencing actual price discovery anymore. It is literally just receiving capital allocation by default.
Even what's left of the quote-unquote active side of the market is no longer driven by human debate. The active industry is basically consolidated into a handful of multi-strategy mega funds. We're talking absolute giants like Millennium, Citadel, Point72. These funds operate with massive 4 to 8 times leverage, and they're governed by incredibly strict drawdown limits. If they hit a limit, it's not a conversation. Internal rules force immediate automated selling. No feelings involved whatsoever.
Now let's speed this up, because this is where the algorithmic loop gets terrifyingly fast. Underneath all of this passive and automated money is the hyperfast options market. Today, same-day expiration options, options that literally expire in mere hours, now make up 63% of all S&P trading. It is incredibly fast-paced.
So the crucial point is, the scale of this continuous, real-time loop is almost unfathomable. On peak days, we are seeing over $2 trillion in notional value change hands in a single trading session. $2 trillion. And every single one of those options forces a dealer on the other side to hedge in real time, instantly buying or selling the underlying stock just to keep their books balanced. It's a continuous, real-time loop of forced mechanical reactions.
Ultimately, the stock market today is just a giant feedback loop. It's algorithms, passive funds, and options dealers all reacting to each other mechanically in real time. And those headlines you read, they are just convenient, dumbed-down stories people use to try and rationalize irrational mechanics. The media desperately needed a reason for that massive April 8th spike, so they slapped the label Peace Rally on it, even though, as we saw, the ships still weren't sailing. So we've successfully deconstructed the illusion. The old system of finding undervalued gems is completely overshadowed by these massive hidden mechanical forces, which leaves us with one final, deeply important question to consider regarding your own portfolio. If the stock market we used to know is completely gone, what are you actually investing in today? Thank you so much for joining me on this explainer. Keep asking the hard questions, and I'll catch you next time.